Welcome, Sunil Subramaniam, who is joining us on the show right now. Hi, good afternoon, Mr. Subramaniam. First up, help us understand that what is your outlook coming in on the markets, because this particular week has been really good for the Indian markets. Finally, some respite kicking in. But do you believe it's sustaining over the next couple of weeks as well, or it's going to be volatile?
It's going to be volatile. I think this week, the reason that there's a little bit of an uptick is because I think domestic fund managers who are still sitting on a lot of cash have done some selective buying. FIs have continued to be selling. And the reason domestic funds are buying is because the uncertainty, the tariff is now localized to a certain tariff that's going to come in. So I think that's the removal of uncertainty means that you go and pick those which are not going to get affected by the tariff and step in. They are still sitting on a lot of cash, but they would still gradually deploy this. I see FISs continuing to be nervous about the overall emerging market pack, including India. And Mr. Trump also is not helping the cause because he announced the tariff and then now again with Mexico and Canada, he's withdrawing it, he's delaying it. So I think that this uncertainty spooks the market. So I think FIs are not going to rush back into a hurry. And domestic fund managers will do selective stock buying where they have clarity for the earnings. But a real move, I would say, would come in April when you have our earnings season. You have all of these tariff scenarios playing out, and maybe that's when you will get a little bit of stability. Otherwise, it's going to continue to be volatile in the short run.
All right, but Sunil, also help us with your take on some of these sectors that have been once again participating into this rebound. Case in point being some of these defense and railway counters. How do you see this this move? Because we have seen sharper correction in these pockets. So should one take this as an opportunity to maybe move out of these counters, given the fact that they're already been an underperformer? Or do you believe that the valuation comfort is still kicking in and maybe some time to put in some money?
Not yet time to put in money. And in terms of booking profits, see, I'll say that if your holding period has got another year and a half to go, up until then you can book profits in these. Because I see the rally, when it recovers and rallies, quality will lead and not necessarily value-driven stocks. Remember, these were value-driven stocks which rode the momentum flow. Momentum is going to take a long time to come back. Now, if you have a 3-5 year view, defense, railways, part of India's infra story, they will do well. So if you have a longer term holding horizon, no need to do anything with your existing portfolio there. But if you have 1.5 year outlook, then I would say book profits. If you've made profits, it depends on when you entered, right? If you had entered in the peak of September, you're probably sitting on losses. So I would say for those, you just make them into longer term investments because there will come a time when these rally. But I don't see that happening in a hurry, right? So that's my view, right? It depends on your holding period on where you take. But definitely, I do not think valuation comfort is still there in this pack yet. There's still some more that they can give up.
So valuation comfort still not in when it comes to some of these defense as well as railway counters. So let's watch out for that. But shifting focus to an exclusive chat then, my colleague Anurag Shah caught up with the management of RITES on where they see business headed and how order flow is shaping up. CMD Rahul Mittal says that they expect to maintain strong financials with 20% EBITDA margin and a profit margin of 15%. Take a look.
Aspire to maintain the strike rate of at least one export order every quarter. So this is again an area which strategically we worked on, and this gap which we had for about 2-3 years in fresh orders, we are past that. I think now we will continue to get fresh export of rolling stock orders.
So you will continue to get the rolling stock fresh orders. So at this order book, what are your margin targets going ahead?
You see, if you compare the past data on our EBITDA margins and PAT margins, they have definitely taken a hit. And this is primarily because there has been a huge shift in the breakup of the competitive versus nomination ratio of our order book. Even till about recently, as about a 1 year back, the nomination was above 50% in our order book. At the end of Q3, the competitive percentage of our order book is 60% plus. So obviously the margins take a hit on that in all streams of revenue, whether it is project consultancy or export of rolling stock. But if you see the trend, we are now in the range of EBITDA margins about 20 odd percent and PAT margins about 15-16%.
Going ahead, just want to understand which new segments you will be exploring, and can we see that what kind of your participation will be for the station redevelopment, for new metro projects, the new metros, metro light, what would be the rights participation?
You see, as more and more importance and thrust is being given to metros in a large number of cities, RITES has been associated right from the initial Delhi metro days. We have done a large number of projects, domestic and international. We recently completed the Mauritius metro. As we speak, we are working, we are the consultants for the Bangalore metro, for the Ahmedabad metro. We are making a DPRs of a large number of metro corridors. So again, this is one area which has huge potential. We will work on that. We are also working a large number of airport projects, both in as DPRs and PMC, because again, there's a lot of push in regional connectivity airports. Highways, we are working a large number of highway projects.
Okay, that's the take coming in on from the management of RITES. But we also caught up with the management of IRCTC to understand how their business has been. Here's a word coming in from CMD Sanjay Kumar Jain, who says he doesn't expect a steep growth in margins, but focus remains on product mix.
No, we are more focusing on our product mix and growth in the laggard sector. So, but natural margin in percentage wise, you may not see that kind of growth which you are envisaging, 35 to 40%. But yes, in absolute term, it will be a very good numbers.
Okay, and from IRCTC, let's talk about the Bombay Stock Exchange. And my colleague Ankur Mishra caught up for an exclusive conversation with Sundaraman Ramamurthy, the MD and CEO, on the latest expiry date change on the exchanges.
We have always been taking such steps as the market wanted us to do. When we restarted Sensex derivatives, we decided on Friday, because that's what the market wanted. After NSE continued to remain at Thursday as stated by them, when the opportunity was given to shift, we shifted to Tuesday because that's what the market wanted. In this instant case also, as I understand, the Nifty expiry has been shifted, weekly expiry to Monday. We will go by whatever the market tells us. So we will wait for it and we will do what market wants. The concept of a unified expiry is nothing new. Thursday as an expiry for Nifty and Bank Nifty, and all the contracts that were introduced at that point of time in BSE was very much prevalent. Notwithstanding BSE spending a significantly large amount as LES and technology service fees, no volumes could be built.
All right, so that was the management of BSC. But with this, let's get back to the markets then. And definitely what we are seeing is that the IT pack is definitely not boring up well. And Kunal, we did discuss in the morning itself that the IT could be an underperformer, like could see some shade of red at least today. Given the fact that, yes, stocks like Infosys, HCL Tech, they are down in trade and one of the top losers in Nifty 50. Any such stock, do you believe that the correction could be more even from these levels?
Yeah, I believe large cap IT stocks, the correction should extend itself over the next few weeks. What happened was, the IT index, when you look at this from 2024 highs, was almost at 46,000 levels. Very recently, the index was almost at 43,000 mark. But then from 43, so the first 3,000 point correction for the IT index was a bit slow, staggered. But the recent 3,000 point correction from 43,000 mark towards sub 40,000 mark, and I think at 37,800 where it's trading right now, the pace of correction was very steep and sharp for the Nifty IT index, and that I believe is a concerning point. And generally when you see such kind of a sharp correction, it indicates that there's further room for the index on the downside. For example, we were looking at FMCG names just about 3-4 months back, where there was a first leg of correction, then a mild consolidation, and then the second leg of correction happened into these FMCG names. I would expect similar trends for the IT names. So my sense is that large cap IT stocks like TCS, Infi, Wipro, etc., they could further drag down over the next 1 to 2 weeks at least.
Okay, further slump in IT, that is what Kunal is anticipating. Sunil, what do you think would be the underperforming pockets in the market in the very near term?
I still think the export-oriented pack is the one which is both sentimentally going to be affected by the tariff costs and the slowdown in the world trade as we now move to a multipolar world thanks to the Trump's tariff tantrums. At the same time, another factor to look at is in terms of dumping by China. See, one of the reactions to Trump tariff thing is if China is taking a very hard stance and there is a slowdown, they are likely to try to dump into other countries. Now, India can put import duties and prevent those Chinese dumping from coming here. But if they go to other countries and are export-oriented sectors. So I think it's a time to be cautious around the export front until this tariff scenario. So that's the first thing which is going to get impacted. And I think it makes sense to wait and watch.
Stay away from some of these export-related counters and plays there. That's the word coming in from Sunil. But another stock within the F&O space that after so many days is doing well is Canfin Homes. The stock is up around 4% in trade. But Naresh, how do you see the technical setup for this particular counter?
The stock has made a good recovery in the last 3-4 sessions, but overall trend is weak. 660 is the first resistance and next is at 700. So for now, the risk reward is not great at current levels. Should see a lot of selling pressures around 655, 660 levels. So would wait out, let it make a base and then maybe look at it.
All right, so wait out and the stock should face some bit of a resistance at these levels. But Sunil, the life insurance counters, any take on this one? Because off late what we are seeing is that they are not participating much in the recent fall, and some of these fund managers seem to be liking this theme along with financials. So, and do you also like life insurance as good place?
I think it's largely the demographic dividend story of India, right? As the younger population comes through, awareness comes through, digitization is coming through. Insurance is one where your now digital access to signing up on new policies is coming up. Penetration is still low. Now with foreign insurance companies coming in, the market penetration should improve. So overall, I think that as a part of the BFSI pack, right, apart from the lending pack, this is the investing pack. And I think insurance is an important thing. Awareness has gone up, and I think that will flow through. So in the short term, there could be volatility, but I think from a medium-term perspective, I will be a buyer in the insurance space, especially even life insurance.
Okay, that's the take coming in on some of the life insurance plays. Today, Zomato is the one which is actually cracking quite hard. About a 4% cut is what you're seeing on that stock. There were some reports doing the rounds that perhaps the convenience fee on some of these platforms, the food delivery segment, that is, both Zomato and Swiggy, for perhaps new subscribers, there's been a discount which has been added to that. It's clearly a bit of a tug of war now at play to try and add in more subscribers and get more market share. Even Swiggy has been under pressure, although a very different chart pattern as opposed to what Zomato has had today. Naresh, what is your sense on Zomato? Currently around that 217 odd print. Where do you think the stock is going to settle in next? And does it seem like there could be some more weakness?
So the previous breakout point was around 240. We saw a breakdown and when the stock went to around 200 odd levels. The last two attempts it has stopped around 240. So for now, it looks like a stock which could range between 210, which is the recent bottom, and 240 as the upper band. If it goes beyond this zone, then we get into a trading move. For now, it could remain pretty sideways for the next few weeks. So that's the range 210 to 240.
All right, 210 to 240, that's the range coming in for Zomato. But now shifting focus to the biggest talking point, and we learn from government sources that Centre is likely pushing for zero reciprocal levy on smartphones. Not just Centre, it's also batting for a 15 to 16% basic custom duty for smartphones and a 20% for TVs and wearables. Let's go across to Sumita Karir for more details. Sumita.
Yes, in fact, government sources indicate that there's little concern so far as tariffs related to the electronics sector are concerned, given that India doesn't import a significant volume of phones from the United States. Now, India government officials have told ET Now that India has multiple tariff lines under ITA 1, and several of these tariff lines have zero duties. And that's the view that the electronics industry is also holding at the moment. ICEA, the industry body for electronics, which is representing several smartphone makers and other electronics majors, has sought for zero reciprocal duty levy on smartphones. ICA states that BCD on basic customs duty on smartphones is within the range of 15 to 16%. That for hearables, TVs and wearables is at 20%. In fact, ICA also suggests that India currently has zero tariff lines. China has 36 zero tariff lines, and Vietnam has 37 zero tariff lines. And it has stated in the past as well that if duties are rationalized, if duties are brought down, that will help in aiding more volume, aiding the domestic ecosystem, which can produce more volume domestically. In fact, so far as the exports data is concerned, well, ICEA estimates that in FY24, India's electronics exports to the United States stood at $10 billion, of which 56% was smartphones. It estimates that that share has risen right now to 62% in the current fiscal year. So reducing tariff lines could be one option for India so far as these tariff talks with the United States are concerned. Remember, government and companies across the spectrum, across sectors, are working together amidst intensifying efforts of finding ways of starving off Donald Trump's reciprocal tariffs, if at all they get imposed, if at all they are aimed at India.
Okay, that's the latest on what India's stance is going to be with regards to tariffs. But just minutes to left before we actually wind up for the week, and we're finally headed in for a firm close on a net basis, or actually that of course is today's chart. If we bring up the over the week chart, that is, I think we're closing in the positive. But Kunal, what about your BTST trades?
So I'll go with two buy calls. And the first one is actually buy on Tata Motors. So after this very sharp correction, it looks like that the stock is settling into a base around the 650 mark. So would look out for targets in the near term to 680, stop us at 630. And Siemens is the other stock after 3 days of strong price action. Today and yesterday we've seen the stock ebbing off. And I think at current levels of 5,000, 5,100, this could be an attractive buy for a potential target just about that 5,300 plus mark. Stop us could be kept at 5,050 mark.
Right. Naresh, what about your BTST ideas?
So first would be a buy on Godrej Consumer. The stock looks like a bounce back trade from here. Stop loss at 1,035, target price of 1,090. Second is a buy on L&T Finance, making multiple bottoms around the 130 mark. Good movement in the last two sessions, expecting it to continue. Stop loss at 140, target price of 147.
All right, so those are the BTST ideas coming in from our experts. But before we wrap up this day, Kunal, can you help us with your take on Paytm? Because what we see is that once again a 3% cut on this particular counter, and the stock has been making the lower low formation. Till what level do you believe this selling pressure could persist for Paytm?
See, right now the stock is into a drag. It's not as if the volumes are rising with every price correction for Paytm, which means that this happens when there is lack of interest or lack of participation into stock prices, and that generally results or the correction ends when the stocks come closer to a major support point. In this case for Paytm, I believe that the first leg of a major support point on the short-term charts is around the 650 mark, which means potentially there could be another drift of another 25-30 odd points for the stock price. But I think if the stock holds on to that 650 levels, there could be a chance where the stock may show a bounce back of sorts.
All right, so let's watch out for Paytm, but every bounce is just getting sold into. So let's see what is next for this particular counter. But a couple of these chemical related plays are doing good. Case in point being SRF, that is holding on to the gains of 3%. Sudarshan Chemicals, almost a 8% jump is what we are seeing, and even stocks like BASF India are doing good for themselves. But Sunil, do you like chemical as a play right now?
A bit wait and watch. The whole tariff scenario, how it's going to affect, because we have a very close competition relationship with China on that. And I mentioned this dumping piece earlier. So I think that it's a good longer term story. I think the PLI scheme will help the chemicals industry in a huge way, especially specialty chemicals and APIs for pharmaceuticals. But this year, I think, until the tariff scenario works out, how China is going to counter that, what we're going to do, I think there will be a bit of volatility. So I would rather wait at this point of time to see how the wind blows.
So rather wait and not any view coming in on the chemicals, and just stay away is that the call coming in from Sunil right now. But for now, we are maybe in for almost a flat close when it comes to Nifty 50, while Nifty Bank 150 points of cut is what we are seeing. The IT is definitely a laggard. Other than that, even Titan, Apollo Hospitals, they are also having cuts of almost 1%. The railway counters have done pretty well for themselves. A couple of these tire counters were up, and even Manappuram Finance, that's another stock when the news flow was not that great today morning, but defying that, the stock is up around 2.5%. And Naresh, Manappuram has been one of those strong candidates because did not participate much in the recent sell-off, and once again above that 200 mark. What does it mean for Manappuram Finance?
Gold prices going up higher over the last many months has been a positive for the stock. Also, the stock has been struggling around this 200, 210 mark for the last many years. That is where it used to get a resistance in 2019 to 2021. Even in 2024, it tried to go towards 225 mark. So some more time here, but the longer term structure is positive. At the same time, Muthoot Finance has done really well. So I would expect going forward in the future, it could break out about the 210 mark, first go to 230, 240, and then maybe even higher. So structurally, a longer term better chart.
All right, so structurally, a better chart coming in from Manappuram Finance, and he also shared his take on Muthoot as well. But given this particular week, it was Nifty Metal that was seen to be snapping its 3-week losing streak, hits this year's high as well. Nifty FMCG, Nifty PSU Bank and Nifty Realty did hit a 1-year low for themselves in this week, but recovered to closing in the green right now. Nifty Energy is at a 3-week high as well. Even a while back, our reporter Prakash was highlighting that how the power demand could be higher in the times ahead, as well as the government is also looking up to pile up some of the coal right now and maybe reach out to some of these power companies to generate more. And even Power Grid was one of the counters within that pack that had a good week overall. But Kunal, any pick within the power space right now which is in for a good closing, because we have seen stocks like Tata Power, Power Grid doing well this particular week?
So I would probably bank on Tata Power from the traditional power space. Even NTPC I think looks fairly attractive. So even though the price action for both of these stocks could be a bit muted today, but when we look at the patterns overall, they're very bullish on many of these names from the power stocks and even the power finance names as such. So the likes of PFC, REC, I strongly believe that at current levels they could be considered as very good buys from a long-term play as well. These stocks have formed multiple or gone through multiple retests of the supports and seems to have established a base for themselves. So I believe that the options are pretty much on the higher side for the power stocks. You can look at traditional names, the PSU names like NTPC, which looks fairly attractive. Power Grid, somehow I believe that the stock is extremely low beta. So that's why I tend to avoid this name. But I think NTPC could be a better bet. Tata Power is another better bet, and from the other finances, I would look at PFC and REC both.
Okay, finally had some reprieve and relief coming in, and we managed to snap the 3-week losing streak. Sunil, Kunal, Naresh, good to have you guys on board with us.